So as I mentioned in the previous section, you can have explorers, you can have evaluators, developers, and producers. And if you want to get involved in the sector as an investor, you can get involved with any of these entities. They offer different return potentials, different risk levels, and sometimes they are separated the way I said. Other times one company can be both a producer, developer, and an evaluator, as well as an explorer. There is no one formula fits all. So when it comes to let's start from the top. If you want to get involved with the producers, well, when it comes to risk, the risk is the lowest with the producers, right? And so therefore your return is also the lowest. When it comes to the producers, they might have a portfolio of different properties producing a particular commodity. Those properties could be in different countries, different jurisdictions, and also they can be producing different types of commodities, not just one. But at the same time, the producers might have other projects in development that will increase or replenish the current production. So it's really up to you. What is your view? If your view is, okay, I'm going to invest in a producer because that particular producer will increase production by bringing other projects into the portfolio, or they will improve the production of existing projects, or they will make them more efficient, or you think that the price of a commodity will go up and therefore the bottom line of the existing producers will be improved. So it's just, you have to know what you are getting involved in and what your thesis is. Going down to, let's say, if you want to invest in a company that's a pure developer, well, you have a situation where they already have a portfolio of projects or a single project that has certain economics, or the feasibility study has been done, and now the next level is to develop it. So where is that producer in the development project? Did they secure the financing? And what type of financing? That alone could be a catalyst for value creation. Or maybe they are during the middle of a development. How is that development going? Is it going according to the plan? Is it not so? But as you can see, when you're getting involved with the developers, obviously the risk is much higher because there are some things that could go wrong. The development can turn out to be much more expensive than they originally thought. Let's say they financed it based on what the study showed, and let's say the study showed that it would cost $1 billion to develop a facility for copper porphyry, and they raised money based on that, and they went through the $1 billion and the project is not done yet, and now they have to go and raise more financing to finish the project. And what if during the time of the construction the price of a commodity collapsed, and now the financing options that were available before are not available? So that's obviously the stock price could collapse because now the company is in trouble. Now, at the same time, if everything is going according to the plan, the price of a commodity is stable, or maybe it increased, or maybe they came in under budget, whatever it is, it could be positive for the stock price, or they simply delivered according to what they promised, and the project was developed on time and on budget, and now it is producing at a rate and at a economics that it was promised to do, or better. So that's how you can make money with the developers. When it comes to the evaluators, well, now we're looking at proving up the resource. It's obviously less, the evaluation process is much less capital intensive than the development. The development could be hundreds of millions or billions of dollars, where the evaluation, we're talking about financing the drilling, enough drilling so that the holes can be spaced close to each other. And as I pointed out in the previous calculation, to drill one hole, depending on the length, could be $250 per meter. And if, let's say, you have to go 500 meters times $250, we're talking about $125,000 for one hole. So that has to be financed, and now those holes give them data, and then that data is compiled, studied, and is used to create all of these studies. At the end, you can't have feasibility study without the drilling data. The drilling data is the most important thing. That's what the studies are based on. So if you have, let's say, a company that is trading for a market cap of $20 million, and they end up proving or evaluating a particular project at, let's say, net present value of $1 billion. Well, you know that a deposit that has a net present value of $1 billion, there's some value to it. Now it's a question of how much can they sell this deposit for to a major mining company. If it's $1 billion, it could sell for anywhere between, I don't know, maybe 20% or 50% of net present value. It could even sell for more than 100% of net present value. It just all depends on the deposit. But let's say if the net present value is $1 billion, and conservatively it can sell for 20% of that. Well, that's $200 million. $200 million compared to the market cap of $20 million, you can see that there is a 10-bagger potential there. And if they can sell it for 50%, it's even more. So that's really how you want to look at it when it comes to the evaluators. And now, when you look at the evaluator's income statement, they're not going to have revenues. They're just going to have expenses. And if you're not familiar with the industry or how it works, you might pass on an investment like this simply because you don't understand it. When it comes to the evaluators, you want to think of it as, let's say you're building a house. So it's an asset that you're developing, right? It's not necessarily, unless you're a development company, then you can have revenues and expenses and all that sort of things. But when you're just developing one house, you are developing an asset, and you are obviously, if you are in the middle of building a house and the house is unfinished, that house is not going to get you a retail price. The buyer for that kind of house might be another builder, and they're not going to pay you retail. So in order to sell the house at a retail price, you have to finish it. You have to complete it, and you have to package it properly to sell it to for the highest price. When you're thinking about evaluators, and when it comes to like Oracle Resources, they are an evaluator, and I talked about them before. You want to think about these kinds of companies as they are producing a product and they're packaging that product. And the way they're packaging it is they are adding value by de-risking it, by drilling, but by compiling the data, by writing, it's all done by third parties. When the drills go, when the drills take out the samples, those samples have to be studied by third parties. They cannot be studied by the companies because they can, fake those results. So it's by third parties. The same thing when it comes to the various reports, whether it's 43101 or feasibility reports, whatever it is, they are done by independent parties. And those parties use the drilling data and the engineering expertise to write those reports. Those reports are 100 pages long, but this is how evaluators create value for the project. So they again, it's like building a house. They are creating a product for the mining companies to buy. And that's all there is to it. When it comes to the explorers, if you want to get involved with those, well, that's the riskiest sector out of all. It's more of a speculation, because really you have very little to. All you have is some prospective land, and geologists promise that there might be something there, and I mean, it's very simplified, but the risk is the highest, because you could spend $2 million drilling holes and it could get you 10 holes and there might be nothing there. So all the money that was raised from investors to drill those holes, if there's nothing there, it goes to zero. Right? So the risk is the highest, but if those holes hit, then the return could be huge. But most of the exploration projects, the success rate is very little. So I don't particularly get involved in the exploration side. I don't feel like I have enough knowledge and edge to be successful in that part. I prefer to get involved with things that I can somehow evaluate, because I consider myself a value investor, so I want to know if the value that I'm getting versus the price that I'm paying. And with the explorers, I know the price that I'm paying, but I have absolutely no idea what the value is. When going back to looking at the evaluators, well, I have something that I can look at, whether it could be the drilling data that's already there, or maybe some historical reports that are being updated, some kind of estimates about net present value. I have something that I can hedge onto. When it comes to developers, there's more that I can evaluate, and of course with the producers there's a lot more, because you already have income statements, you have revenues, you have expenses, and you have all of these studies that they have from the earlier processes. So just in summary, you can get involved in all of the steps, some of the steps. It's really up to you how much money you want to make or lose, and how much risk you're willing to take on.